Hello, and welcome to Business Talks, a podcast by Safri. As always, please join us for an in-depth discussion on the topical issues impacting businesses and their owners. We're here to help guide you through these critical areas and to provide practical tips to support your business. Please don't forget to subscribe on your preferred podcast platform. I'm Tom Alun-Jones, joined by my co-host, Zoe Thomas.
Hi.
And today we have a special guest, Adam Kay, who hosted his legendary annual budget breakfast event in London the morning after the Chancellor's announcement.
Good morning.
Thank you both for joining me at this busy time. The 2025 autumn budget is now with us, with Rachel Reeves finally standing up in the Commons on the 26th of November. And since then, businesses have been digesting what these changes mean for investment, tax planning, and compliance. We have produced a huge range of content on this topic across the Safri Budget Hub. For example, the previously mentioned budget event and a host of other material. In this episode, we'll unpack the measures that matter most for UK businesses and give you practical tips to navigate next steps. Before we dive into the headlines, looking back, my view is the 2024 budget really came for business, with some major headline measures. For example, the changes to employers' national insurance. By contrast, this year's budget feels lighter on big-ticket items for business to digest. Instead, what we've got is a variety of smaller changes, and no, I'm not going to use that word, each one adding to the complexities for businesses to consider. Zoe, as a quick temperature check, what are your initial thoughts on this year's budget?
Yeah, thanks, Tom. As you said, for businesses, the announcements weren't really sweeping reforms. They were targeted changes designed to influence key business decisions. The measures that the Chancellor has introduced will definitely affect how companies invest, incentivise their staff, and manage compliance over the next few years.
Interesting. Adam, what are your thoughts?
A couple of things, really. Firstly, I would say the worst thing about the whole budget, and something which I don't think I've ever experienced before in about 20 odd years of covering the budget, was the level of uncertainty and the leaks before the budget. We were all, us as accountants and tax advisors, as well as our sort of contacts in the legal profession, were completely blown out dealing with things which didn't actually happen. And so the amount of sort of lost productivity for businesses and their advisors worrying about things which turned out to be sort of not in the government's plans, I think was really damaging, I would say. And the second point is that the bigger changes for business arising out of the budget are probably not direct tax changes, but things like the minimum wage increase, which, we're now, I think, one of the highest in the OECD. It's going to be enormous for lots of our clients. And the changes to business rates, so particularly the RHL relief, which, is going in, I think, April 26. We were hoping for an extension to that or something, and we got a few little we did get some rates released, but the outcome is likely to be that a lot of our business clients are going to be paying a lot more. And they're not the sort of things we talk about very often as accountants, but they are super important.
Right, thank you both for that. I think we'll now get into a bit of the detail. Adam, what are some of the other headlines for business?
Yeah, so there's, as you both said earlier, that there are lots of kind of smaller changes. I think the main thing for businesses is the change to capital allowances. So we've got a 40% first year allowance, which is going to come in for main rate expenditure. You sort of think about that and you say, well, okay, we've already got full expensing for corporates. We've already got AIA. So to what extent is this 40% first year allowance going to be used? Well, full expensing doesn't apply to unincorporated businesses. So you can see the first year allowance being used for them. And the AIA is capped, and also it doesn't apply to all the assets. So it doesn't apply to things like leased assets. So there are some businesses which are going to be using this 40% first year allowance, which kicks in from April 2026. The other thing, which probably is a lot more wide ranging, a lot more important, is that the writing down allowance for main rate expenditure drops from 18% to 14%. And that is quite a big fundraiser from the budget. I think I haven't got the numbers in front of me. I think it's about $1.5 billion a year they're planning to raise from that. So lots of that sort of older, either leased asset expenditure or stuff bought before the full expensing came in. And so those older balances. So yeah, capital allowances changes. We've got some changes to EMI schemes. So basically a lot of the limits have doubled. So larger companies, employee limits 250 goes to 500. The gross assets limit goes from 30 million to 120. The value of the shares which can be under option goes from 3 to 6. So bigger companies can now qualify for EMI, which is really good because it is the sort of the gold standard share option scheme for many clients. And usually share option planning is, we want to do EMI and we only do other things if we can't do that. So that's all good. The one thing they didn't change was that the maximum amount that can go to any employee is still 250,000, which I think it's been there for about 20 years. And so that's not now looking a little bit light for some schemes. So that is worth keeping an eye on. Lots of the other thing on this is EIS and VCT. So there's some changes there. Again, larger companies can now qualify. So the sort of size of the companies that can qualify for those schemes has doubled, which again, very welcome. There's a slight decrease in VCT income tax relief from 30 to 20, which is going to be quite painful for that market, I think. But generally, EIS and VCT fundraising are going to be available to larger companies. Lots of changes to indirect tax, so gaming duty, big increases in gaming duty. Low value customs duty is one of the biggest revenue raisers in the budget. And so that's going to apply to people importing to the UK. VAT changes for taxi companies. So some enterprising taxi companies have been saying that they're travel operators or tour operators and therefore claiming the sort of reduced VAT under the TOM scheme. So that's not going to be allowed anymore. And some transfer pricing changes, lots and lots of changes to transfer pricing coming in the next 12 months. Really is a complete game changer for UK businesses on the transfer pricing side. We already knew some of it. So we knew that the medium company exemption was going to go. We were expecting UK to UK transfer pricing to go within, in many cases. But there's going to be some new annual reporting requirements for multinationals and also a new sort of ICTS return, which is a sort of, you need to make an annual filing which captures specific financial information about your cross-border transactions. So again, that's just something to bear in mind for those sort of clients. I mean, there are quite a lot of small changes, but the last one I was going to say was EOTs, employee ownership trusts, is the way to do a management buyout now. They've pretty much replaced management buyouts as the sort of the method of choice to bring new levels of management into shareholding, and the tax relief is going from 100% to 50%. So, which is, I think, a reaction to the fact that when they started with EOTs, they were expecting to give away about 100 million of capital gains tax in a year, and it's now at 1.5 billion, I think. So it's still, EOTs are still going to be beneficial, but not as beneficial.
Grand. Thanks for that, Adam. If you want to know a little bit more about EOTs, our sister podcast, Private Wealth, did an excellent episode a few months back, and they do remain increasingly popular with our client base. So it'll be interesting to see if that has a material impact. Across our client base and listeners, there are a range of business sizes. You've mentioned quite a large range of those changes.
Yeah.
How do we think those changes will hit owner-managed businesses versus larger corporates, for example?
Yeah, I think the big changes for owner-managed businesses, or some of the big changes for owner-managed businesses over the last kind of 12 to 18 months and going forward, and maybe on the personal tax side. So we've got the inheritance tax changes coming in, which are going to hit and are already hitting quite a lot of owner-managed businesses. We're seeing quite a lot of restructuring of those businesses to enable inheritance tax planning to happen. And the change, which is super welcome in the budget, is that the £1 million BPR exemption is now going to be transferable. So that is a big thing. There is less welcome news, which is that does affect some of our clients, particularly in Scotland, which is that there are changes to agricultural property relief, and UK farmland owned by overseas corporates can now be caught by inheritance tax. And we do have quite a few clients in that area. So if you've not picked that up, and if you're an overseas company holding UK farmland, it's important to look at that pretty urgently, actually, particularly because, as I always say, inheritance tax is weird. And the way it works is quite weird. And so some group structures, it looks like they'll now be caught by inheritance tax, but won't qualify for any relief because APR relief only applies at the top level. So if you've got subs anyway, it's quite complicated. But if you're an overseas company holding farmland, it's important to pick that up. And other than that, you look at, for smaller businesses, you look at family investment companies, which are quite often set up to have a non-working spouse and children to get dividends. Obviously, less beneficial now, probably still worth it, but might want to have a bit of a think about how that changes. And in general, SMEs are going to benefit, I think, from the EMI expansion and EIS and VCT changes. So those are going to be quite important for those. The other thing that I haven't mentioned yet is payroll tax changes. So umbrella companies now, the sort of PAYE responsibility is going to move from the umbrella company that employs workers to the recruitment agency that is the sort of conduit, or even where there's no recruitment agency, to the business itself. So businesses that hire temp workers need to have a bit of a think about whether they're caught by the umbrella company rules, which were announced in the budget. Because again, that's forecast to raise quite a lot of extra tax just by changing who's liable for it, rather than by actually changing any of the rules. So it's worth keeping an eye on that, I would say.
Thank you. We do try when we're making these podcasts, and this is a particularly technical one, to make them practical for our listeners. Admittedly, we can't cover everything, but Zoe, what are the biggest likely sticking points or particular areas for our clients to consider?
Yeah, I was speaking to our new capital allowance director, Phoebe Hindlet, earlier this week, and she pointed out as a point to, I suppose, what Adam has been saying, that although the 40% first year allowance is a welcome measure for the unincorporated businesses, as it's available on the main pool from 2026, it actually doesn't match the 100% full expensing available for corporates. So although it is actually seen as a real positive, it's still seen as a slightly unfair measure against the corporates, but I suppose it's a step in the right direction. It's probably also helpful to point out that the 40% allowance will also extend to assets provided for leasing within the UK, which is one of the measures coming out of the recent consultations. So we are being listened to, which is good. However, on the flip side, as Adam has also mentioned, writing down allowance for the main pool expenditure is going from 18% to 14% from April 2026, which obviously will represent a real effective cash tax increase for businesses, especially those with large historic pool balances that typically rely on the writing down allowance to reduce their tax liabilities. So it's a double-edged sword, I suppose. However, one thing is seen as a positive. I think HMRC are trying to reduce the amount of regulatory burden and filing requirements. So CIR simplification. So one of the budget measures that was incredibly welcome as a reform to the corporate interest restrictions reporting. They were aimed to remove some of the red tape that I know a number of clients and people that I've spoken to anecdotally have said, it is a bit of a burden and is something quite easily people trip up on. So the 12-month deadline for appointing a reporting company is going from March 2026. So appointments will be confirmed within the CIR return itself, which makes much more sense and is much more workable. So that's a really good move. But it is important to note that there is now a £1,000 penalty if you file without a valid appointment. So again, you've got to watch out for that. And plus, electronic filing and disclosures are kind of down the line towards the end of 2026. So businesses do need to be aware of kind of some of the filing requirement changes that are coming in.
Right. Thank you. So far, we've covered the headline rates and the huge numbers of changes. And what's also struck me is the varying dates. They don't all seem to come now. They don't all seem to come at the same point in the future. So there is a huge range of changes and the variety of timelines for their implementation. What advice would we give to business owners looking to navigate these challenges? It does feel like a difficult time. Zoe, let's start with you.
Yeah, you're right. It is really difficult because there are changes coming in this year. So as in 2026, quite a lot coming in 2028. So there is a whole range of stuff. I also think what Adam has touched on, the transfer pricing, that will be a big change because we were expecting some of it, but not everything. So, and that'll catch a lot of people that would never ever thought they were in transfer pricing regime. So I think businesses need to be aware of what is coming and the dates and the deadlines. There isn't one big headline change, which makes it far more complicated to kind of understand how it's going to impact your business on a day-to-day basis, what that means for your investments in the future, your staffing costs, and also, as we said, kind of like compliance and filing obligations. I think being proactive is key. The tweaks of their own might be seen as quite minor, but they do create a lot of complexity when you layer them on top of each other. So if you're not planning ahead, I think the key for me is you could be missing out on tax reliefs that you could be claiming, but also you don't want to get caught up in new rules that are filing requirements that could easily be managed and met, and submitting things on time. So you don't want to get caught up with new fines that are going to be imposed. So I think that you need to, I know I always say this, but I really do think it's key now, is engaging with your tax advisor is more important than ever. Businesses that plan early will be the ones that kind of turn these changes into opportunities.
Absolutely. Adam, do you have anything else to add on this point?
Yeah, I think so. Just looking at maybe the smaller business kind of side, if you're a small business owner and you haven't updated your will yet, you've got until 6th of April to do that. And if you're sleeping on that, it's not even something that you necessarily need Safri's to help you with, but you need to speak to a lawyer about that. I saw one a couple of months ago where it said everything to my wife except shares in my business, which I leave to a trust for my kids. Shares were worth well over 100 million. So we were looking at a sort of 20 million pound inheritance tax liability on his death if he hadn't got that changed. And that's pretty common, I would say. So if you're sleeping on your will, don't go and get that looked at. PAYE changes for temporary workers, I talked about, that comes in April 26. Act now, I would say. And looking further ahead, the salary sacrifice changes, which I haven't mentioned at all in this budget, in this sort of chat today, but the £2,000 salary sacrifice changes don't come in till April 2029. So for some reason, so you've got some time there, plenty of time there to sort of engage with employees, work out what they want, and work out what you as an employer are going to offer as part of your employment package. But again, start to think about that and have these conversations. There is also a loan charge opportunity coming up. I don't think we know the exact dates yet, so I certainly didn't when I did the budget webinar last week. But so if you've got any loan charge stuff outstanding, the settlement looks quite beneficial. So it's worth sort of picking that one up as and when and seeing if that's where you want to go. More positively, positive tax changes rather than negative tax changes. The EMI changes come in from April 26. And in particular, they're going to allow you to change some elements of existing options to make them a little bit more beneficial without that qualifying as a disqualifying event. So once we get past April, good time to look at your employee share offering and see if that's still fit for purpose and can you make it a little bit better.
Interesting. It seems to be the key takeaways from both of you are fairly similar, in the sense that this budget has raised a huge number of challenges for businesses in terms of increased complexity, but also some real opportunities and some potential tax savings for particular businesses. And the key takeaway, as always, is proactively seek advice, both on the tax side and the legal side, and to make sure that you're incorporating these changes into your strategy and future decision making. I'm afraid that is all that we have time for today in terms of our review of the autumn budget for businesses. I appreciate, given this sort of podcast format, that we haven't gone into a huge amount of technical detail, although we have done more than I thought we would. If you want further information, then please reach out to any of us directly or review the Autumn Budget Hub on our website. Thank you, Zoe and Adam, for joining me today, and thank you all for listening. As always, this discussion is for information only and does not constitute tax advice. Please seek professional guidance before making decisions. At Safri, we provide a range of tax and advisory services to help businesses and their owners achieve their objectives. If you'd like to find out more about the services we offer, or for more information and insights, please do visit our website at safri.com.